Hey everyone, welcome to the webinar. I'm Brad Pickering. I'm the head of risk management with CPG, and I have Lenny Morgan on with me. He's our insurance expert, and this is developed for commercial real estate lenders. And there's really two types of people that I think are going to be benefiting from this today. So, number one is you're a commercial real estate um, loan deal originator. And the second type is you're an attorney who works on commercial real estate loan agreements. You're either developing the language or you're negotiating the loans. And I know, Lenny, you wanted us to put this together just based on the countless examples that you've experienced over your career where these loan agreements are misaligned with the insurance coverage, and due to some nuance in that, or some unknown detail of that, that it's unknowingly exposing both the lender and the borrower to uninsured issues. And you've said to me many times, greater than 70% of the agreements that you look at have some sort of a critical flaw in them. And so you were motivated. You said, hey, let's get together. Let's put this together and walk people through these issues. And so, our goal is to show you, what are the issues, and then how do you close those gaps? And we're going to do that through this agenda, which is Lenny's going to take you through, why the insurance matters, what's happening, what are the insurance market trends right now. So it's May 2025. What's going on in the insurance markets right now? What are the things that are causing the insurance, the delays or derailing loan closings? Of course, deal people want to close their loans on time. And so if we can prevent issues proactively, we want to do that. What can be put in place in the agreements so we're reducing the borrower pushback, and then going over how to easily implement these things. So, Lane, we'll just maybe start with an example of that example where, due to a small change in what was going on in the insurance market, the agreement not picking up that change, and an inexperienced borrower leads to a significant issue.
Welcome, everybody. Thank you for taking the time today to listen to our video. As Brad said, this is driven by our interaction with lawyers and commercial lenders. And as we try to push back on some of these items, there's some resistance because it's new to them. And so we just kind of want to walk you through that. So to Brad's example, what's at stake here with a subtle change? Imagine the financial impact to one of your commercial borrowers if they were blindsided by a $10 million deductible that threatened the liquidity of the entire group. That's what we have here. We had a commercial borrower who had personally collateralized a loan on an apartment complex in northern Florida. The borrower thought they had a hurricane deductible of approximately 1.5 million, depending on the valuation at the time of claim and the 3% named storm deductible, and it really turned out to be $10 million. And that was quite the shock to everybody. And the lender was unaware of this exposure because the technicalities of their loan did not delve into this specific issue that is starting to trend up in the insurance world. Therefore, neither borrower nor lender were aware of it. And so the borrower in this example actually reached out to their lawyers to see about just turning in the keys to the property and walking away. So that's the type of stuff that happens with subtle changes in some of the insurance policies in the industry, and the lack of what we'll call lawyers and borrowers keeping up with those trends. Look, our number one goal at CPG is facilitating the loan closing. We always say insurance shouldn't just be a box to check. It should be, provide valuable input. And we understand that it can directly impact your timelines and loan collateral and even your borrower relationships if, we provide of a difficult closing process. So, number one, our goal is to never stand in the way of a closing. We're going to bring you things that we think are critical, but we're also going to bring them to you with, here's the impact, here's what most of our other clients do, and then we're going to put it into a spot where you can make a business decision to either go forward with our recommendation or accept and understand what the gap is if you don't. Ultimately, I think the difference between CPG and any other advisor, we referenced box checkers. We don't want to be box checkers here, but we want to give you a valuable report. When we look at loan agreements, like any other agreement, we see lawyers very good at designing a traditional two-party agreement. In this instance, lender and borrower, it's very clear what they must do with you. Where it really starts to get a little bit nebulous and gray is when they start to ask for insurance coverages. And what we do at the end of our process, you're going to have what we call the aligned design, where your agreement triggers all of the key aspects of the insurer's policy and at least flags those that we think are problematic so that you and your borrower understand where you have gaps, where you don't have gaps, and we try to avoid the surprises that happen when you have that claim time experience, like we discussed previously about the $8 million escalation of the deductible because the borrower didn't do what they were required to in the policy. And so we try to flag those. And then, the aligned design essentially makes your loan agreement contemplate the actual language of the policy because the policy itself is a legal agreement, legal contract, just as your loan agreement is. So the two need to function together and cohesively as opposed to being opposed to each other. Right? This is really what we're talking about, right? Policy language is evolving. Imagine that we have thousands of customers at an insurance company and they get hundreds of lawsuits a year. Whereas, as a lender or even as an advisor like myself, probably seen 10 lawsuits against insurance companies in a 30+ year career. So what does that mean? Well, that means that the insurance company's policy language is evolving at a much quicker rate than the loan agreements that they are pertaining to. And so without reading them, if your loan agreement hasn't been reviewed in 2 to 3 years, it's probably outdated. And many of the loan agreements we look at, they use 1980s, 1990s language. I hate to be so critical, but that's really what we're seeing out there is loan language that is so outdated that it uses the wrong definition of coverage. It uses the wrong terminology. It really leaves it exposed. But technically, because your language is so historically outdated, the coverage that's been sold to your borrower is technically appropriate, and they can check all the boxes to say, yes, you're free to close, even though you're significantly exposed. So, the exclusions, endorsements, conditions, litigation experience, all of that kind of plays into what's actually there from a coverage perspective. So just want to make you understand that this continual evolution on the insurance side is compounded by the lack of evolution on the loan agreement side.
So knowing all of that, and I guess, Lenny, after you kind of explained that to me, we then package that up into a framework to help people to kind of navigate through this. Like, how do you actually solve that? And so that's why we came up with a framework for doing that. And so, the first thing that we help people think about is like, well, what is the strategy and what is the context of the loan? That's the starting point, because is it going to go into a mortgage-backed security type product, or where's the money coming from? And what is the position of the loan? Is it the senior? Are you acting as senior lender? Are you, mezzanine? Is it a pref equity deal? Like, what's the actual structure of that? And then what is the actual purpose? Like, is it a construction loan? Is it acquisition value add? Is it some sort of operating exposure? Is it a permanent asset? And so on. That's the starting point. From there, then it's looking at the risk, and as the lender, what is your risk appetite and risk tolerance? How much risk are you willing to take, and how much risk are you looking to transfer? And then there's an insurance mechanism sitting behind that. Like, what deductible levels are acceptable, and what limits are acceptable, and what cat coverages. Lenny, you referred to the named windstorm example. It's like, well, what cat coverages are acceptable and we're going to require. Step 3 is the design, then taking that and packaging that up and into the, what are the indemnities of the agreement, and then specifically, what are the insurance requirements that are being stipulated in the agreement, and then manages, of course, closing the loan, and then there needs to be a mechanism to monitor the ongoing insurance expirations of the borrower. Of course, all of this is kind of from an internal view. Hey, here's the things as a lender, here's where we would like to be at. But there is also the market backdrop, which dictates, certain things just aren't possible. It's kind of what you're referring to, Lenny, right? Insurers keep narrowing coverage over time, right? We used to give this, but now now we're changing zones for where a tier 1 named storm zone is, and so on. Keep changing things. And so there's a market backdrop to this. So Lenny, why don't you take us through a little bit of the coverages that come into play?
Sure. So traditional cat coverages, most of us have heard of. Most of the loan agreements we look at do a fairly good job of stating, if you're in an earthquake zone, you need to purchase earthquake coverage if you have a PML above a certain level. In flood, if you're in a primary flood zone, you have to buy coverage. In a primary wind zone, you have to buy named storm or windstorm coverage. They do a very good job of just stating that. Generally, they put something in there that, you can buy sublimits. But, what they don't do a very good job of is, what if you're in a secondary, that is it 100% flood? Is it 100% windstorm? This is where areas start to push back. But these are the traditional, and I would say that, 90% plus of the loan agreements that we look at touch on what we'll call these big 3 of catastrophic coverage, at least referencing them, and that sublimits would be available. However, where they start to lack a little bit is what we'll call the emerging cat coverages. As you all have read, California Palisades, Maui, other parts of the country have experienced a tremendous increase in wildfire coverage. And so wildfire coverage has now been deemed to be a cat coverage. Well, what does that mean? Well, that means that when you issue your loan agreement and you say you want an all-risk policy covering 100% of the building, that language may put your borrower in breach, because they may be in California and they have some sort of wildfire sublimit, or they may have some wildfire loss prevention that's required before coverage will apply. And they may need to have a standalone water source in California. We're starting to see all sorts of unique little items pop up, and the loan agreement doesn't even reference wildfire, let alone allow us to check a box. But because it's so vague, many of the reviews that we do post-claim try to figure out why something wasn't paid. It was because the policy had some unique language in there around wildfire, and technically it met the requirement of the loan agreement. The same is true for hail. Hail now used to be, the $25,000 or the $5,000 deductible, but because when a hail event happens, it doesn't affect one building. it generally affects thousands of buildings in the same area. Hail has now been deemed to be a catastrophic coverage by all of the insurers, and they've got all new hail zones, Texas, Colorado, Oklahoma, other parts of the Midwest. Tornado alleys pretty much are very common for hail as well. And so, again, if your policy doesn't stipulate that hail can have a sublimit or a higher deductible, things like that, then technically we're putting your borrowers in breach right out of the gate because we just haven't kept up with what we'll call the modern policy form. So let's now we've talked about the cat coverage. Now let's talk about this narrowing of policy language that Brad and I have both referenced. Named storm versus flood coverage. When you think of named storm, you get storm surge, you get pounding rain, you get the North Carolina situation where, it just washed out small towns in the valleys, things like that. Well, about 4 years ago, the insurance company started a trend that basically said, even if you model for named storm, including storm surge and rain and damage from flood, we're actually not going to cover flood. We're going to exclude it from the definition of named storm. And this is the exact scenario that we were talking about. Should a client have that $8 million shortfall? I mean, this is the language that we use to come up with that example. Borrowers may need to purchase named storm and flood, and they need to model for both. We very rarely see this in the loan agreement be split. So here's what it says. In the event covered damage by flood arises out of a named storm, the maximum amount that will be paid per occurrence for all such damage by flood shall be the sublimit of liability for flood. So, they may not be in a primary flood zone in middle of Florida, but they may be in a tier 1 named storm. And they may get a river that overflows, or they may get even tidal action that comes up that far. And essentially what we've done is we've said you're only required to buy coverage for half the anticipated damage of a named storm. This is becoming a very popular way for insurance companies to cut costs in Florida and other parts of coastal areas and sell policies there at a reduced rate compared to their competitors that don't have similar language. And thus, as a lender, you probably have many of these endorsements buried in your borrower's policies that you're unaware of. Right? Earthquake versus earth movement. Very similar thing happens here. Earthquake provides coverage for losses incurred to seismic events, specifically seismic events resulting from the movement of tectonic plates. Earth movement, on the other hand, encompasses a broader spectrum, such as landslides, sinkholes, various forms of ground displacement, including man-made, such as excavation. So a lot of times we push back and say, we agree that you're in Florida, you don't need earthquake coverage, but you do need earth movement, because what if you have a sinkhole? What if you have other construction activity? Many times when a borrower asks a lender to waive earthquake coverage, what the borrower gets in return is a full waiver of earthquake and earth movement. We just did one in Northern California, and it's in a valley that recently had a large wildfire, so I'm going to put all of these together. And suddenly they raised the warning level of mudslides in the area. And although it wasn't a primary quake zone, now by waiving quake, we've also waived earth movement, which included mudslide. So when we did our review, we did the inquiry. And of course, there was an increased level of worry about landslides and mudslides in the area, but it was too late as the borrower had already agreed to waive all earthquake and movement coverage. So it's very important that you don't mistakenly cancel coverage for earth movement when you're only intending to cancel it for earthquake. And those two seem very related by the words, but the definitions could be further apart. Now let's talk about the deductibles, right? We see a lot of, I just saw one today from a lender, no deductible on liability. Unless you have a single location mom and pop borrower, the chances of them buying a policy with a zero deductible is extremely remote. And then when you start to get into the institutional borrowers that use pension money and then borrow and do a combination of, they get into the multi-billion dollars of assets under management. They probably have $1 million deductibles, and so the all other perils AOP deductibles are ever increasing. They're starting to use captives and self-insurance. And how are you responding to that, right? I mean, we can't say that you can't say no, because some of these are the best run companies and the borrowers that you really want to have. And so what you really need to do is design insurance language that is both acceptable to what we'll call as buying coverage in the standard market and is acceptable to the captives and self-insured. And it's a long process, but we can explain that to you in further detail. That what you really need to create is baselines. This type of coverage or similar. And then that way, when they go self-insured, you can say yes, as long as it meets these requirements. And then we talked about it, but catastrophic deductibles have changed as well. It used to be TIV, which is total insured value, and now it's per unit of insurance. And they break each building down into 3 units: business income, contents, and the structure itself. So they could have 3 deductibles per unit of insurance, as opposed to just one for the total insured value of the location. If you have a warehouse, that's probably not a big issue for you. But if you're insuring for apartment, or if you're borrowing or lending on apartment buildings, think about a 30 or 40 or 50 unit complex. Suddenly that per unit of insurance deductible just really got on your radar. And that's the type of things that you need to think about. Hail, as I mentioned earlier, is now deemed to be a catastrophic. So they put a 3 or 5% deductible on it generally. And wind, in some cases, is now catastrophic. Now, note that I did not say named windstorm. I didn't even say tornado. I just said wind. And many policies we're starting to see, to cut cost, they are starting to say that you have a 3 or 5% deductible if damage is caused by wind, i.e., a strong breeze. That's all it takes. So just some things to be aware of, that your language needs to encompass what we'll call these evolving language changes. Flood NFIP zone. We all know that if you're in a primary flood zone, what we'll call the A, then you in your loan agreement give them the flexibility to buy a sublimit. However, your policy doesn't reference zone B. Zone B says in most of the policies that we've reviewed lately have some new language that has to do with zone B, that says if you are in this zone and NFIP coverage is available to you, you must buy it, or we're going to increase your deductible to the available limit in that area. And the NFIP program right now nationally has $500,000 limit available. So essentially, they're taking your flood deductible for being in a non-primary zone, whatever it may be, 25,000, 50,000, and they're automatically bumping it up to 500K per building. And again, per the example that I gave to start, if you got 20 buildings in a complex and you have a river that runs over and gives you a flood in what we'll call a non-primary zone, you can have a substantial increase in deductibles that can put the financial ability of that borrower in jeopardy. So in understanding these negative deductible trends in the insurance industry is really going to help you and your clients. Brad?
Great. So look, as the lender, what is it that you really want? First and foremost, closing the loan. And then from there, you want to know that your funds are protected, that you don't have a balance sheet exposure. And also, you also don't want to foreclose on it. You don't want properties coming back to you because of the borrower's inability to pay deductibles, and those sorts of things. So here's some of the most common issues that we see. The first one is really around the policy language evolution, all these things that Lenny just went through, and that the agreements, the loan agreements, are not keeping up with that. I think second is insurance delays closing. And so I think a couple things can really help there. Having a really proactive approach, having people like us or firms similar, having a really proactive approach for making sure that borrowers and their brokers understand the requirements. I mean, truly understand and can meet those requirements ahead of loan closing. And we see, we have the really high-end institutional borrowers, but then we have this class of, it could be people doing 30 million, $100 million loans. It's a sizable loan, yet these firms these borrowers are very inexperienced, and so are their brokers with respect to insurance at those levels. And that is one of the huge problems we see that causes delays in getting connected to those kinds of borrowers and their brokers early. Checkbox solution versus really solutions-based. And, we think as we explained, as the framework that I took you through, understanding the strategy of what's happening and really getting in there and stitching these pieces together and coming up with a solution that is actually going to work, and you're not going to end up with these financial exposures. And then investor non-compliance. So looking at where are the source of the funds for the loans and aligning with that. And that's what we call these cascading requirements. And so it's important to look upstream. Are there securitization requirements? Are there investor requirements? Are we turning these into mortgage-backed securities? And looking at what the reps and warranties are of those agreements, and then incorporating those downstream into the loan agreement, and then therefore into the borrower. And we've worked with some firms where we've been able to do that, and it really streamlines their ability to then be able to take the loans and package the loans into the mortgage-backed type products. And then downstream, and Lenny, I'm going to get you to comment here. I think downstream is imposing those requirements on the borrower, but also, and we reference a couple of contract types here that come into play with some of these loans, depending on what's going on. Can you just give us an example of some loan or some contract types that are important around a loan closing?
Sure. A lot of times, lenders really are neutral as to whether their borrower would place the policy or the general contractor for their borrower would place the policy. But one thing that they don't really think of is they talk about property insurance and they talk about business income insurance in the loan agreement. But what they don't talk about is loan carrying costs, that if the loss occurs during construction, before the rents are signed or before a lease is signed. And so we've had a $600,000 uninsured expense. And we also did not have the broker or the general contractor's fee included in a builder's risk that was placed by the GC, and they were then asking for a $600,000 change order. So it's very important that we understand what we call the soft costs that go into a loan carrying cost calculation for your borrowers if they're going to build a building. Once it's stabilized and it's operational, it's much easier to determine what the loss of revenue is and what the damage to the building is. But during construction, if it's partially finished, if we have to extend the construction period 6 months, 8 months, 12 months, those costs are much harder to determine. But as a borrower, you still want to get paid your interest, you still want to receive your payments. You don't want those to be punted down the road. And then finally, in the facility management agreement, we see much stronger facility management agreements than we do lender agreements, believe it or not, because they have a sophisticated risk manager and lawyer on staff. And so they're writing that their revenue must continue for 24 months following a catastrophic event or a casualty event. And so many times we're seeing that your borrowers are out of alignment with the facility management agreement because all they really looked at was the loan agreement to determine their insurance. So we try to bring all of those cascading requirements down and say, yeah, the maximum that's required is this, therefore that's what we need to buy to, or we need to negotiate that amount down. And so that's what I think Brad is alluding to, that, just because we look at the borrower's requirements, it's not in a vacuum.
And then how do you easily and effectively kind of implement some of this? We think that the starting point is updating the loan agreements. That's probably the best place to begin. And then secondarily to that, looking at how do you streamline and improve the insurance review process throughout. But and so the way to do that is and the way to improve the loan agreement itself and to get updated languages is to go through these series of steps. And so first and foremost, looking at what are the contractual requirements upstream and downstream, as Lenny just went through, and making sure that those things are integrated in. Then also looking at insurance market trends and making sure that flood zone B or whatever it was called, Lenny, that we're clear on what those changes are, we're up to date, and that they as well as we're not asking for things that are just totally not market as well, because that's just going to waste time with back and forth and negotiating back and forth, right? So get to market, get to what the market insurance requirements are, get those things in, getting the then a lot of times it's going to be asset specific. What are the catastrophic requirements? What kind of zone is the thing in? Are there unusual policy definitions that come into play based on the location of the specific asset, based on our risk appetite, risk tolerance? What kind of deductible levels and limits are acceptable? And then we end up with this market insurance requirements, and then we put that into, and we actually, then you update your loan agreement, and then that's your starting point for all of this. As advisors to both some of the world's largest lenders and real estate owners and borrowers, our approach, we're trying to always take an approach to helping those clients that's going to save time and money, right? And so we want you to have a better experience. We want you to close deals faster, more easily through what we're trying to do. And so, I think what's beneficial is we understand both sides, representing borrowers and lenders. I think this strategy-driven approach is key, where we're looking at the context of a deal and not just looking at something in vacuum and looking to check a box, because ultimately when things go wrong, you and your firm are not going to have the right protections. And so making sure that the solution is the comprehensive solution that's needed. And supporting the borrower without slowing the deal. As I said, there's a lot of inexperienced, as much as the loan might be $100 million, there's a lot of inexperienced borrowers and brokers in dealing with and getting the right insurance stuff there. And so our team is always really trying to help them through the process or offering alternatives if needed. Lenny, do you want to add a comment?
Yeah, actually I do. We just recently did a transaction for a short-term bridge loan. And, there weren't any specific insurance standards. So we tried to advise the borrower that if you're going to refinance this, you really need to understand what the next phase or the traditional lender that you're going to reach out to here in 9 or 12 months to refinance this is going to look for. They're going to look for terrorism. They're going to look for at least some earthquake coverage if you're in California. They're going to ask for flood coverage unless you're in a primary flood zone. And they were quite inexperienced, as Brad referenced, and they flipped that upside down and said, well, we're not in a flood zone, therefore we shouldn't have to buy coverage. And I said, well, no, that's not how it works, because with all of these crazy storms that we're having in California and the Midwest and everywhere, we're having some what we'll call predominantly dry areas get inundated with water, and we're having floods in spots that never get it. And then they didn't want to buy terrorism coverage because they didn't think that their buildings or facilities were subject to that. And I'm like, well, it's not about whether we think you're a primary target. It's whether the next lender has it in their requirements. I showed them 4 or 5 loans that I received since I opened their file, and every one of them had quake, flood, and terrorism requirement. Ultimately, because those were not in the original loan agreement that was proposed, they had to waive those. And we got through the closing. As we said, we didn't want to stand in the way. But what I suspect is the insurance budgets are going to be way off, because when they go to refinance, all of those coverages are going to be required by the next, what we'll call traditional lender. So just want you to understand, we can support the borrower without slowing the deal, and we'll resolve these coverage gaps as best we can. It may not be favorable, but at least we understand where they need to get to for the end of the transaction.
Well, look, we hope this was helpful to you, and we hope that through these steps and slides and information that you're able to follow them well enough that you're able to implement some of these things. And I guess the other thing that we would throw out there is that, with this proven framework and with our insurance standards and things, we're also happy to, I think we quickly and easily help clients through understanding kind of how they move forward. So if that's also of interest to you, our Lenny and my contact info is here at the bottom, and feel free to reach out to us if you have questions or want to follow up on more specific items. Lenny, anything else to add?
No, thank you for the time and watching our video. Hopefully you found it helpful. And as many of you are probably thinking, you haven't looked at your insurance language in your loan agreement in quite a while and wondering if it's out of date, then obviously please reach out to Brad and I because it's probably not.
All right. Thanks, everybody. Have an awesome day.
Take care.